When you're buying a home, the money that you need for the purchase comes down to your down payment and your closing costs. Today, we're going to talk about your down payment, or how much money you're going to need when buying a home. Here you'll see different percentiles, and we're going to dive into each one and why they might be important for you. We're going to start with 0% down loans. The two biggest are VA loans and USDA loans. A VA loan is for veterans. If you served in the military, you might qualify for a veteran loan. It's a 0% down loan up to 4 units. So you could buy a condo, single family, 2, 3, or 4 unit property with $0 out of your pocket. There's also no PMI, no private mortgage insurance. Usually when you put less than 20% down, you have private mortgage insurance. A USDA loan is a rural loan. It has to qualify for the area you're buying in. Let's move on to 3% down loans. The 3% down loan is most commonly found for a conventional first-time homebuyer program. These two programs are called Fannie Mae Home Ready and Freddie Mac Home Possible. If you haven't owned a home in the last 3 years, you'll qualify for one of these programs. These programs are allowable for single-family homes and condos. If you're buying a multifamily though, you won't be able to put 3% down with a conventional loan. Moving on to FHA loans at 3.5% down, you could buy a single family all the way up to a 4-unit property. You could also buy a condo with an FHA loan. However, the association has to be approved by FHA. FHA loans are very popular for buyers that are looking to buy 2, 3, and 4 unit properties and want to put a low amount of money down. The 3.5% down payment is much lower than what you would be able to put with a conventional loan. This is known as house hacking, where you'll buy, let's say, a 3-unit property, live in 1 unit, and rent out the other 2 units to help cover your mortgage payment. FHA loans have mortgage insurance for the life of the loan if you're putting less than 10% down. If you put 10% down with an FHA loan, it'll fall off after 11 years. So the goal with an FHA loan is to buy the home with a low down payment, and then after you build up enough equity, refinance to a conventional loan so that you can get rid of your private mortgage insurance. Now, it's not always the case where you're going to be refinancing to a conventional loan, but in most cases, it'll make sense. Either A, to get rid of PMI, or so you could go buy another home with an FHA loan. For an FHA loan, you can only have one out at a time. The next down payment is 5%, and this is most common for conventional single-family homes. If you're not a first-time home buyer, this is what you'd be able to qualify for. The great thing about this loan product is that you could buy a new single-family home, primary residence, every year with 5% down. I know many people who have bought a single-family home with 5% down, they move into it, and then the following year, they do the same exact thing where they buy another single-family home with 5% down, move into that home, and use the house that they bought a year ago as a new rental property. You could do this up to 10 times, and it's a great way to start building your real estate investment portfolio. With 15% down, you can invest in a single-family investment property. 15% down is also the minimum down payment for a 2-family owner-occupied home with conventional. The benefits of buying a 2-family home with a conventional loan versus an FHA loan is that your private mortgage insurance per month is going to be cheaper. However, I'm of the mindset it's better to buy your first home with an FHA loan, use your eligibility, and then save the additional down payment that you would have put down for a conventional loan and save it up for your next down payment on your next investment property. So those are 15% down loans. If we move on to 20% down, this is where private mortgage insurance will fall off of your loan. So if you put 20% down, you no longer have to worry about PMI. You can invest in single-family condos with 20% down. And if you're looking to buy a 3 or 4 unit property owner-occupied, you can buy that property with a conventional loan. If you're putting 25% down, this unlocks the ability to buy an investment property 2 to 4 unit property. The minimum down payment is 25% for those transactions. So that should give you a good idea of the minimum down payments you need for certain loan types and programs. Now, where can the money come from? It could come from a variety of sources, such as a checking account, savings account, retirement account like a 401k, or even brokerage accounts. One important thing to note about a 401k, you can either borrow against your 401k or you could liquidate it, meaning you pay a penalty, which is 10%, and you pay taxes on any money that you're taking out. We advise clients to borrow against their 401k. You can take a loan of up to $50,000 in most cases, and then you pay yourself back each month in each paycheck with interest. So you're borrowing the money from yourself, and then you're paying yourself back the money with interest to yourself. It's much better than liquidating your account, paying a penalty, and taxes on that money. You can also get a gift for your down payment. This gift can come from family or even your employer with some loan programs. Now, all of your assets need to be seasoned and verified. Seasoned meaning they have been sitting in an account for 60 days. Verified meaning we could verify which accounts it's come from. For example, let's say you're going to be using your checking account to buy your home, but you have funds in your brokerage account in a stock portfolio. If the money's been transferred within the last 2 weeks, that's okay, as long as we could verify that it was previously in your brokerage account for at least 60 days. So if you move the money from your brokerage account to your checking account, we just need to see the transaction history or the bank statements showing the money leaving one account and entering into another account. As long as we can trace and verify that it's been in one account for 60 days, you won't have a problem using those funds. What you can't do is take cash from under your mattress and use that for a down payment. I hope this video gave you a good idea for the minimum down payment you need when buying a home. The one thing that we didn't go over that you should keep in mind is closing costs. And typically these are about 3 to 6% of your home's purchase price. We recommend that clients have that saved up as well, even though in some cases you can roll that into your loan. If you have any questions, please drop me a message. My contact information is below.